Okay, Chuck, if you do or would, how would you trade VXX? The direct answer to my question, Chuck, is going to be very carefully, especially in the current markets. What is VXX? I've got it right here. Why do I have it right here? I'll show you in a minute. What essentially is what I'm looking at is my watch list. These are my married put positions that I currently have open, and I add UVXY and a VXX. VXX is a volatility ETN, an exchange traded note, very similar to an ETF, which is what UVXY is. So it monitors changes in volatility, just like the VIX does in that case. Okay, but because it's an ETF or an ETN, it's not the same. I mean, it's close. You see here, we're up 1.7. UVXY was up 2.8%. VXX was up 2%. So they're usually pretty close, but VIX usually reacts faster on the bad news, the sudden bad news events, than VXX or UVXY. Eventually, those two will catch up, but VIX tends to react fastest. But you can't trade it as an underlying. I can't do covered calls. I can't buy shares of VIX, the VIX, if I'm trying to use that as a hedge or a protection or a management, depending on which strategy that I chose. Okay, let's just take a look first at the stock chart itself. Let's see what we've done in the past few months. So we're kind of all over the map here in this case. I'm not saying hindsight's 2020, but where did we start off the year? We started off the year kind of okay. But there were fears coming in. There were fears of inflation. That had already started, right? Remember that we had those kind of fears of inflation coming in. Actually, January here is in this point. So at the end of December, navigate over here. There we go. Let's see. I want to use, in this case, I'm going to use the bright green. All right, I apologize. So this is December. We were coming in at the end of December pretty good, and January started, and then volatility started to move about. There were fears here about inflation. There were fears here still about the supply chain and other issues. And we had this other huge event coming in that was a big fear. It kind of ebbed off, and since then, the last 2 weeks, we know what's been going on, unfortunately, and that's been causing these other rises in the volatility. What do we still know going forward? We don't know the outcome of the event in Ukraine, unfortunately. We all wish we did, and we all wish for peace that was done. But we don't know the outcome or how bad things can get. We see some easing off the past couple of days of news, and then another spike back up. We're seeing increased oil prices, increased inflation, all these things going on. None of it's going to turn off immediately, unfortunately. We know that. We can't just turn off a spigot there and help and solve the end of the problems. I don't mean we as in the US. I don't mean we as in me and you. I mean across the broad spectrum. Everything I'm seeing from economists, talking heads, things of that nature is that the expectation of inflation, high gas prices, and things of that nature is expected to last for the next couple of months, with increases still going up, then eventually hitting a peak sometime and then pulling back down. That's just what I've been hearing. I guess I kind of agree with it because I don't know. So I would expect volatility in that case to continue fluctuating. Good news and bad news. Good news comes out about an event in Europe. Okay. Good news comes out about an easing of gas prices, things of that nature. We're going to see this ebb down a little bit. Then one little thing spikes it back up. One little event, and it could be anything. It could be more sanctions. It could be peace talks failed. It could be anything. It could be just a sudden move in gas prices. It could be the UAE, again, and OPEC deciding not to increase output and spike back up. So here's the dilemma. What are the strategies that an investor might use when you're seeing a stock or a condition that's bouncing around up and down? In my opinion, what I would like to do in the best case scenario is take advantage of a strategy that profits in both directions. We're talking about a long straddle position, buying an at-the-money call and at-the-money put, maybe 45 to 60 days out in time. We're talking about maybe a long strangle position, a little cheaper, buying an out-of-the-money call and an out-of-the-money put in this situation. If you wanted to play it directly by purchasing the security positions, then you might want to look at a collar. I know this looks like a bull call debit spread. I know this looks like a bull call debit spread, but I'm talking about a standard collar, buying stock and maybe selling a call at the money, where my return is maybe 2 to 3% to the upside, and buying a slightly out of the money put so I can control the risk to 4 to 5%. I am purchasing the underlying security. I'm not doing a direct spread because of these volatile movements. In the spread position, you could see a time when you're down 80 to 90% or when you're up 40%, and you're going to have to manage that quickly because, as you see, the big gaps, the big runs up usually only last a day or two. And we've been moving constantly up because of those events. But we hit a peak here again, and it sort of pulls back. The VIX chart will look very similar. We had a pullback again this morning, but then it started to rise right back up with news that came out towards the end of the day and the trading as it was going in those cases. Okay. And a discussion I had during a coaching session today was for earnings. I'd mentioned Ernie's approach for doing the long straddle or the long strangle position around earnings. Let's just change some of this here. Okay, let's see here. I'm sorry, folks, long straddle. And I want to do the short as well. I'll do short strangle. Should have done straddles, but that's okay. So as I mentioned, the long straddle is a buy price. Buying an at-the-money call and at-the-money put. There's an introduction to straddles video here on the power options page. So with the wild swings, I'm trying to profit in either direction. Now, I'm not saying I have a direct approach for this, Chuck, but what I'm saying is that this requires management, and what I just showed on the chart explains why. If I did an at-the-money straddle right now or an out-of-the-money long strangle position, and we see another spike in VIX, VXX, UVXY, historically we see that 2 or 3 days later it pulls back. So that when that spike occurs, I probably want to be on my toes and looking for a way to take the profit off of this call position and maybe readjust the put, or maybe move the straddle up if it's profitable to a new position, because 1 or 2 days later it might pull right back down. And then maybe I can take the profit there. But you've got to be nimble with that. You've got to be on top of it. You've got to be watching your screens constantly, Chuck, watching the position. Yes, maybe when that first gap up occurs and you've got a profit on your call option, even though the put's losing, maybe sell half. Take half of the calls off the table to help lower the cost of the straddle, and then maybe readjust the position to go to the new at-the-money strikes. And then if it pulls back, you might be able to do the same on the put side. It's complex. It's not simple, don't get me wrong. That's why I was saying maybe the long collar is a better approach, because you control the risk to single digits when the VXX pulls back. And you can still make the good return to the upside if it moves up. But because you're in the stock, even with the wild swings, you're protected on both sides. You could still make 2 to 3% to the upside on the standard long collar. You could only lose maybe 4 or 5% to the downside. Yes, the comment comes in, and I agree with it. With everything the way it is now, just what we showed on the FDX options with the increased implied volatility. But even with VXX, the VIX options, and UVXY, we're also seeing now what? We're seeing an increase in implied volatility across the calls and the put, which means what? These are going to be, actually, they're not that bad if you look at them. But I'm talking about the straddle here, 155 to 131 to be $2.88 to get into this long straddle position at the money strike. And that's only 7 days out. I'd be going further out in time here. I'd probably be going 30 to 40 days out in time. Let's just go to standard April expiration. Now what are we talking? 355, 335. Let's call it even $7 to get in this position, which means what? In the next week or two, I'm going to need to see a good swing up 2 or 3 points or down 2 or 3 points to where I still have time value left. I'm going to profit. The trick here, though, is if VXX moves down in price, starts dropping down to 23 or 24, that means the market's going up. That means this implied volatility is going to decline as well. Look at the implied volatility on the puts there, 1.11, 1.06, 30 to 40 days out in time. The reason I'm bringing this up is because of the comment that was made just now by John. I'm sorry, not John, it was Jim, is saying that, well, it's going to be really expensive. Why buy when you can sell? And what he's talking about is selling an out of the money strangle position. And again, just look, meaning what? Meaning that maybe if I went out to April or to May, I'd sell a, let's say, 30 strike call and maybe sell a 20 strike put on SPX. I'm sorry, VXX, my apologies, VXX. But again, with the wild swings we've seen, we've been below 20 recently. We've almost flirted with 30. And it's a high margin position. To get into that, even with these lower strikes, it's a high margin requirement. And if there is an event that's unexpected, some unexpected event going forward in that case, then we're going to be stuck in a rough position where we may have large losses. Let's just take a look here. And we're going to use VXX. In that case, I was talking April 14th, and I mentioned the 30 and the 20. So 37.45 cents on the 20. Expectations here on the call side pretty high, 263, 264. So this is essentially a naked call and a naked put and a short strangle. I know most brokers have some calculated margin requirement they require, but look, even though I'm taking in $297, that put is so low price compared to the call. I mean, yes, we're 6 points out of the money and only 360 out of the money here. My God, it's 7 times the cost almost. That's telling us that there's a lot of activity on those calls. So I should have gone further out to make it even. But look, yeah, you can make $297, but you're going to have to put up a large requirement for the naked call and the naked put position. And there's no guarantee that if something gets settled quickly, and if inflation drops quickly, even in the next 20 to 30 days, we're probably sure that's not going to happen. But if it did, this could drop down to $16, $17, $18. We're in the loss zone. Something happens, escalation, which we don't want at all. We want more peace. We don't want escalation in this war. But it could go up to 34, 35, or 36. You're looking at large losses there as well. So it's a balance. That's why I kind of said maybe the long collar position. I'd like to be in a structure where I can profit both ways, not lose in both directions, and not hope that the volatility stays range bound in the next 20 to 30 days or so. Shorter term, 7, 8 days maybe, but that's taking a gamble with everything that's going on, in my opinion. I don't take that risk. Ernie and I do not do the short strangle positions around earnings. I know some do. We prefer to use the straddle or the strangle, buying the straddle or the strangle in that case, Chuck, going forward. Now, how do I trade VXX personally? I trade VXX as a market hedge. Let's go back here to this here. And I'm sorry, I'm in UVXY right now. What I tend to do is I might buy calls on UVXY, buy calls on the VIX, or buy calls on VXX back in December. Had a few shares here of UVXY. This is to hedge the spread portion of my portfolio. I just bought shares because the volatility was starting to creep up a little bit. So I just directly bought shares, 20 shares, and then built it up, added another few shares later on as the market started to go down starting in January there. And this is to hedge if I have calendar spreads open or bull put credit spreads. I track it here in this, this is just the webinar account, but I track it here against the married put position. Not a huge gain, but, it's gained $306 for me. And that's because, bought shares at one price when it was down at 11 and bought some other shares when it was at 14 and bought some other shares when it was 15. So I got a cost basis of $13.80 on 50 shares that are using as a hedge. I'm not saying this is the only way to trade VIX. I'm not saying this is the only way to trade UVXY. I'm not saying this is the only way to trade VXX. I'm saying right now it is very uncertain market, Chuck, and trying to do a directional strategy, credit spread, bull or bear, debit spread, bull or bear, diagonal calendar spread, iron condor going neutral on a security that's going to have has the potential, to have a lot of drastic movement with things that are going outside of the economy, things that are going on inside of the economy as well. It's kind of dangerous. In good market conditions, we actually have a default search. I'm sorry, it's not there. Let me go right into the search. I apologize, Chuck. And right here, We have VIX bear call credits, looking for bear call credit spreads on the volatility index. And right now, none of them match because it's not the right market condition to do this. It's still too volatile and still too choppy. But when the market is gradually going up, and hopefully we get back to that sometime soon, it's going to be a rough ride for the next couple of months. I'm just going to be dead straightforward with you of my expectations. I could be completely wrong, and that would be great. It could be worse than I expect, and that wouldn't be good. But that's why we want to have, again, that protection in place, whether it's protecting a portfolio, protecting a spread portion of the portfolio. Playing the volatility directly can be tricky. Even with calendar spreads, buying an option that's further out, going directional or double diagonals, which is like an iron condor, you got a great chance to make good premium in the short term. But the wild swings in that iron condor or that double diagonal can cause you to lose significantly on one side or the other with events that are coming out that we don't have absolute any control over whatsoever.